or the chapter right now. So welcome everyone to chapter 3. We're moving right along, and in chapter 2 we began talking about the accounting cycle. And we talked about how we analyze various transactions, and we think about accounts that are being affected. And then we learned an important concept of a debit and a credit. A debit means what?
Left side.
Left.
Yes. And a credit means?
Right side.
Got it. Very important concepts to learn, because debits in some accounts increase the account. Debits in other accounts may decrease accounts. So basically, we understood how we go about analyzing transactions, deciding what accounts are being affected, and learning about the journal entry, how we will put certain, the debit first, the account that is debited first, the account that is credited next. This chapter focuses on a new concept for you. It's called the accrual basis of accounting. What is the accrual basis of accounting? Well, basically, guys, revenues we record in the period in which the goods or services are provided to the customer. Not necessarily when we get paid for those goods or services, but when we completed them or the transaction took place. That is called the revenue recognition principle. It's really, really important. Revenues are recorded in the income statement or in the books when we did the work, not when we got paid for it. And expenses are reported in the same period as the revenues they help to generate. So the concepts here we want to be cognizant of is revenues do not get reported when we get cash. Revenues get reported when we do the job, finish the job, do the work. And the expenses are reported in the same period as the revenues they help to generate. That's called the matching principle. So this is a great example. Now, cruise ships aren't a great example with the COVID day and age, but we're still going to use this. Let's just say this cruise ship was going to run in April, for 2 weeks in April. But in March, there were purchases of products for the cruise ship. In April, there were purchases of fuel. And in May, they paid the salaries of the employees that worked on the ship in April. So expenses were paid for in March, April, and May, but the actual cruise took place in April. The revenues are going to be recorded in April because the cruise happened then. And the expenses, even though some were paid for in March, some were paid for in April, and some were paid for in May, all of those expenses are going to be recorded in April because that's when we recorded the revenues. Most expenses are recorded in the same period as the revenues they help to generate. Other expenses indirectly related to producing revenues are recorded in the period that they occur in. So guys, which statement best describes when expenses should be recorded? Are they recorded when they're paid? Are expenses recorded the day a company promises to pay? Are expenses recorded when the cost is used to help produce revenues?
Yep.
If I had like clapping, I would be showing it now. Yes, they are recorded when the cost is used to help produce the revenues. So why are we dealing with accrual basis? What's the difference between accrual and cash? Well, we're going to find out. The revenue recognition principle states that we record revenues when we provide those goods or services to the customer. That is the accrual basis. But the cash basis of accounting means we just record cash when it's received. So if under the cash basis of accounting, even if we haven't done the work, we record the cash as revenue. Or we've done the work in October, but we didn't get paid till January, we record the revenue in January. It's not real indicative of what we've really done. It's just all about cash in, cash out. That's why accounting, we operate on the accrual basis. We record our revenues and goods and services when we actually do the work. Our expenses are in the period that are used to help produce the revenues. But if we were dealing with the cash basis of accounting, we would only record those expenses when we paid them. The cash basis of accounting is not generally accepted accounting principles, so that's why we do not use it. We are required to use the accrual basis of accounting. So here's an example. When we provide golf training to customers for cash for $4,300, under the accrual basis of accounting, we record the revenues when we did the work. Did we do the work? Yes. Therefore, we record the revenues, right? Now, if we were using the cash basis of accounting, that means we record the revenues only when we get cash. Did we get cash? Yes. So the transaction on December 12th, actually, we would record those revenues, both of them, the same, being under accrual basis it works, under cash basis it works. But look at December 17th. December 17th said we provided golf training to customers on account. Did we do the work? We did. We need to record the revenue because we did the work. No, we didn't get paid yet, but we still recorded as revenue because we provided the services and we are due the money. Under cash basis of accounting, we wouldn't record that as revenue because we didn't get the cash. Now, here's another one weird. We received cash in advance for 12 golf training sessions to be given in the future. Under accrual basis, did we do the work? No. We would show that as a deferred revenue, remember, a liability. But under cash basis, we would show we earned that money, even though we didn't do anything. Okay, let's look at expenses. We pay 1 year of rent in advance for $6,000. Did we actually use that rent? No. On December 1st, we didn't use $6,000 worth of rent. So under the accrual basis, we only record it as we use it up. Under the cash basis, we would show that whole 6,000 as a rent expense in that month. We purchase supplies on account for 2,300. Well, under accrual, we don't write off those supplies unless we use them up. They're an asset. Under the cash basis, we wouldn't write off those supplies because we didn't pay for them yet. So under both scenarios, we would not be recording those supplies. And then on December 28th, when we pay salaries to employees of 2,800, we would show it under accrual basis because they earned those salaries. They happened in that period. And under cash basis, we would show it because we actually paid the cash out. The difference between accrual basis of accounting and cash basis of accounting is all about timing. Under the accrual basis of accounting, we record revenues when we provide the goods and services to customers, and we record expenses with the revenues they help to generate. However, under the cash basis of accounting, we record revenues when we receive cash, and we record expenses when we pay cash. How about this one, guys? Which of the following would be recorded as an expense under the accrual basis of accounting? The company purchases office supplies with cash and does not use the supplies. The company uses utilities in the current month period but does not pay cash. The company provides services to customers for cash. Or the company purchases equipment by borrowing from the bank.
B.
B. Any other ideas? Anyone else? B is perfect. You are exactly right. B, the company uses utilities in the current month but does not pay cash. We don't care about if we paid cash or not. Did those expenses happen in that month? Yes, they did. They were used up in that month, therefore we write them off. Now, A, the company purchases office supplies with cash and does not use the supplies. That's an asset. We're not going to even expense it until we use them up. C, the company provides services to customers for cash. Is that an expense? No, that's revenue. That's why we don't use that one. And then the next one, the company purchases equipment by borrowing from a bank. Is that an expense? What is equipment?
Asset.
Asset.
Asset, exactly. How about this one, guys? Which of the following would be recorded as an expense under the cash basis of accounting? I'm jumping to get a Diet Coke. I'll be right back. What do you think? Any ideas?
Wouldn't this one be both A and C?
Okay, you think A and C. Who else wants to put in some thoughts?
I think A.
Leo, why is it A?
Because the company paid out cash. So
That's
it's recorded as an
paramount,
expense.
right? Leo, why isn't it C?
I get it.
C.
You get it, Katie?
Yeah, because we're receiving cash.
Well, and we're providing a revenue.
Exchange.
It's
yeah,
not an
exchange rate.
expense. Remember, guys, when we provide services to customers, those are revenues. When we purchase office supplies, we're going to use those to help make revenues. Okay? So we're going to look at these scenarios and we're going to determine the date for which the company recognized the revenue under the accrual basis of accounting. Number one, American Airlines collects cash on June 12th from the sale of a ticket to a customer, but the flight occurs on August 16th. When would American Airlines record this revenue?
The 16th.
August 16th. That's when the flight took place, right? How about this one? A customer purchases sunglasses from Eddie Bauer on January 27th on account. Eddie Bauer receives payment from the customer on February 2nd. When will Eddie Bauer record that revenue?
The 27th.
Exactly. That's when the transaction took place. Next, on March 30th, a customer pre-orders 10 Supreme pizzas without onions from Pizza Hut for a birthday party. The pizzas are prepared and delivered on April 2nd. The company receives cash at the time of delivery. When will Pizza Hut record that revenue?
April 2nd.
April 2nd. Okay, guys, this isn't tricky, but think about it. A customer pays in advance for a 3-month subscription to Sports Illustrated on July 1st. Issues are scheduled for delivery each week from July 1st through September 30th. When would the Sports Illustrated record these revenues?
July 4th.
Every month.
How about every week?
Every time a issue is
That's
delivered.
what I meant.
Yes, excellent, guys. As each magazine's delivered. Excellent. I think I doubled up on these, sorry. Now, we're going to talk about adjusting entries. There are 4 types of adjusting entries. Think about this. Sometimes things happen during the year. And they're often these transactions that we've been talking about, such as purchasing supplies or doing work for someone. But there are also sometimes we have to, at the end of the year, make some adjusting entries of things that have happened during the year. And we do these, record these journal entries so we ultimately can prepare accurate financial statements. For example, when we purchase supplies, we purchase them and put them in a storage cabinet. Okay? Then sometimes we have to look and say, oh, we don't have all those supplies here anymore. We only have $100 of the 2,000 we ordered during the year. So sometimes we're going to have to create an adjusting entry to show true figures of what's really happened. Or sometimes we have money sitting in a savings account And we need to look back and go, wait a minute. We've earned money on this we haven't taken care of during the year. We need to report this. Or we might have purchased rent 12 months in advance. And at the end of the year, we look and we go, wait a minute. We've used up 10 of those 12 months of rent. We need to record that. Do you see the various things I'm talking about? So, some of these transactions, these external transactions, we record as they happen. But when we have something called a prepaid expense, which is the cost of an asset, it's acquired in one period, but it's going to get recorded as an expense in a future period. They normally get recorded as an asset initially because they will provide a future benefit for us. But then in that future period, we're going to need to expense it. Know that adjusting entries, journal entries, regarding prepaid expenses, we will always adjust them by debiting an expense account and by crediting an asset account. This is one of those like cheat sheet moments to write down. Here's an example, rent. We paid cash in advance for 12 months of rent. Remember we paid $6,000 on December 1st? So we recorded prepaid rent, which is an asset, on December 1st. But guys, by the end of the year, which was just a month, $500 of that rent expired. Remember that $6,000 of rent was good for 12 months. But on December 31st, guess what? A month has been expired. So to record the journal entry, the adjusting journal entry for prepaid expenses, remember it said we debit the expense and we credit the asset. Since we've used up $500 of rent, we now will debit rent expense for $500 and we credit prepaid rent for $500. What does this do? This increases our expense, which basically lowers our retained earnings, our stockholders' equity, and it reduces our asset, doesn't it? What happens when we purchase $2,300 of supplies, but during the month we used up 1,000 of it? So at the end of the month, we only have $1,300 sitting in our supplies closet. Don't we need to debit an expense and credit an asset to show we've used up some of this asset? Now here's a new one you're going to learn about. We purchased $24,000 of equipment. But by the end of the year, we're going to allocate some of that cost to this year. So if you think about it, that equipment is going to last us for many periods, many years. But the way we allot a portion of that asset to this year is a term we call depreciation. All assets, be it automobiles, furniture, computers, buildings, get worn out with use. So when we purchase equipment on December 1st for $24,000, it's only going to devalue because of use and time. Therefore, when we allocate a portion of that cost of using that asset in the current period, this is a new word we're using called depreciation expense. We're allocating or depreciating this asset to be utilized throughout several years. And our way to show that cost is by debiting an expense, and we're crediting a new concept. We're going to call it accumulated depreciation. It's basically what we call a contra account. Instead of actually crediting the equipment account, we keep track of what we're reducing that asset by using an account called accumulated depreciation that offsets that asset. So that way we know how much depreciation we've taken against that asset. So here's an example. Golden Eagle Company prepares monthly financial statements for its bank. The November and December adjusted trial balances include the following accounts. So you see here, we've got on November 30th, supply sitting of 2,000. On December 31st, you see we have supply sitting of 3,500. We're going to have to see what happened. Prepaid insurance. On November 30th, we have a debit balance of this asset, prepaid insurance, of 8. But on December 31st, it's down to 6. Then we see salaries payable, which is a liability. On November 30th, we show a credit balance of 11,000, but look, on December 31st, we're up to a credit balance of 16,000. Then we have another liability called deferred revenue. Remember, deferred revenue is when someone gives us cash, but we haven't performed the work yet. That was sitting with a credit balance of 3,000. As of December 31st, now it has a credit balance of 1,500. Then it gives us some more information. It says the following information also is known. Purchases of supplies in December total 4,500. It says no insurance payments are made in December. 11,000 is paid to employees during December for November's salaries. On November 1st, a tenant pays Golden Eagle 4,500 in advanced rent for the period November through January. Deferred revenue is credited. Our job is to take this information and to show the adjusting entries that were made for supplies, prepaid insurance, salaries payable, and deferred revenue on December 31st. What we're doing is we're really analyzing these transactions. Let's start with supplies. Do you see in supplies here, we ended November 30th and we had a balance of 2,000. It's also telling us we purchased supplies in December of 4,500. Okay? So 4,500, if we started with 2,000 and we added 4,500, that would have made it 6,500. Right? How much did we, excuse me, let me just see. Purchase supplies in December for a total of 4,500. So that means our 2,000 we ended in November, plus our 4,500 we purchased in December, gives us a balance of how much? 6,500. But if this is showing 3,500, doesn't that mean we had to have used up $3,000 worth of supplies in December? So basically, this journal entry shows the adjusting journal entry that was made for the supplies that were used during the month of December. Again, we started with 2,000. It's telling us we added 4,500, which would make that 6,500. But if this ending number shows 3,500, then that means we must have used supplies expense, 3,000, and we credited our asset, 3,000. Remember, a prepaid expense. Next, we started with prepaid insurance of 8,000. It told us no insurance payments were made in December. But do you see we ended with 6? Doesn't that mean we used up $2,000 worth of insurance? So the adjusting entry would have been a debit to insurance expense for 2,000 and a credit to prepaid insurance for 2,000. Next, salaries payable started at 11. It said the following information is also known. 11,000 is paid to employees during December for November salaries. Well, you know what that means to me? At the end of the month, salaries had accrued, had been utilized, incurred for 11,000, but we hadn't paid them yet. So what we did is we probably at the end of the period debited salaries expense, credited salaries payable. Then in December, we probably paid this 11,000 by debiting salaries payable, crediting cash. Now we see a salaries payable sitting as of December 31st of 16,000. That means to me, we probably incurred salaries of 16,000 during December that we haven't paid yet. So we would have debited salaries expense of 16,000 and we would credit salaries payable of 16,000. Because remember, we record expenses in the period to match the revenues. These salaries happened in December. We need to record them in December. Deferred revenue, 3,000. At the end of December, it's 1,500. Well, this is interesting. On November 1st, so this is before even November 30th, someone pays Golden Eagle $4,500 in advanced rent for the period November through January, where deferred revenue is credited. So what this means to me is we rent out space. So someone gave us $4,500 up front for 3 months worth of rent. So it must be on November 1st, we debited our cash, we credited our deferred revenue. Then on November 30th, a month had gone by, we probably debited our deferred revenue, credited rent revenue. Then On December 31st, we probably did the same thing. Debited our deferred revenue of $1,500, credited rent revenue or service revenue. And we're probably going to do that again in January, aren't we? Which of the following is recorded with an adjusting entry associated with a prepaid expense? Anyone know?
I think A.
Anybody else? Any other ideas? Guys, go back to that page. Remember I said, here's a good cheat note? What did that say? What was being debited and what was going to be credited for prepaid expenses? Back here?
Your debit expense, credit asset.
Excellent. I forget where I put it, but it was here somewhere. Excellent. You debit expense and you always credit the asset. I said, make that a cheat sheet note. Remember? It's not really a cheat sheet. You get my point. So that is exactly correct. When you are recording an adjusting entry associated with a prepaid expense, we always debit the expense and we credit the asset. Now, let's talk about this depreciation. Do you see Federal Express shows all their assets? And then the assets are totaled, and then they show less accumulated depreciation of 21,141,000 or 21 billion, whatever the number is, 21 billion, with our net property and equipment of 19,550,000. What does this mean? They keep these numbers intact. These were the actual costs of the equipment. When depreciation is taken against this equipment, instead of crediting these assets, we credit what we call this contra account of accumulated depreciation to keep track of the depreciation we have taken since its life on these assets. So the true net cost of our assets are 19,550,000. Even though we purchased them for 40,691,000, we have used up 21,141,000 of these assets, meaning we've taken some depreciation against them. Which of the following is equivalent to the book value of an asset? The cost of the asset plus accumulated depreciation? The cost of the asset less the accumulated depreciation? The estimate of time the asset will last, or the cost of the asset divided by its life?
B.
Excellent. Excellent. B. Remember here, it's the cost of the asset minus accumulated depreciation gives us the true book value of the asset. Excellent. Now, we started talking about deferred revenues last week. I told you this is the only payable you will ever see that doesn't have the word payable, right? Deferred revenues happen when a company receives cash in advance from customers. Cash received is initially recorded as a liability because we owe something to the customer. We owe them a service or a product or a job. But once the obligation is met, then we can record the revenue and we can get rid of the liability. So whenever we're dealing with deferred revenues, know our adjusting entry will always be to debit the liability account and credit the revenue account. Always, guys. This is another one of those cheat sheet moments. For deferred revenues, the adjusting entry is to debit the liability to get rid of it or reduce it and to credit the revenue account. So here's an example. Cash received in advance from a customer for products or services to be provided in the future are recorded as a debit to cash, a credit to the liability deferred revenue. But by the end of the year, some services are provided. So what if we did provide some of these services? $200 of this $600 was completed, which means we have $400 remaining at the end of the month. But do you see what we'll need to do is debit the liability, deferred revenue, and we'll credit the revenue account, service revenue. This shows we did provide $200 worth of those services we need to provide. This portion of Netflix shows the current liabilities they have sitting on their books. Now, isn't this interesting? Deferred revenue of $274 million. Do you know what I bet that is? You pay your Netflix account up front, don't you? You pay it up front for use for the month. And then after the month is completed, they've earned that revenue. And I don't know how everyone does it. I think we pay our bill every month. Honey, do we pay our Netflix bill every month? I think maybe sometimes people may get a package where they pay it a year at a time. But I know we pay it up front for services for the month. When that month has passed, then Netflix can record that as revenue. But when we pay it up front, we really haven't, they haven't provided us with a service yet for the month of, say, for example, February. I'm sure it comes out of our account, maybe January 25th for the month of February. It's a deferred revenue in their books because they haven't earned the job yet. They haven't earned the revenues. Let's look at this exercise. There are these various transactions, and we're going to record the necessary adjusting entries for Shocker at December 31st, 2018. It's telling us that no entries were made during the year. So on November 28th, 2018, Shocker receives a $4,500 payment from a customer for services to be rendered evenly over the next 3 months. Deferred revenue is credited. Okay? So think about it. On November 28th, they debited cash, Shocker credited deferred revenue. It's supposed to happen for 3 months. What will we show on December 31st, we will debit our liability and we will credit our service revenue of $1,500. Why $1,500? Because it told us services will be rendered evenly over the next 3 months. 4,500 divided by 3, $1,500 a month. On December 1st, the company pays a local radio station $2,700 for 30 radio ads that were to be aired 10 per month throughout December, January, and February. Prepaid advertising is debited. Okay, guys, go look at that cheat sheet. Whenever you have a prepaid expense, which is an asset, it tells you what do you need to adjust? You adjust a debit to expense, a credit to the asset. Since a third of these radio ads were used up in December, we're going to debit advertising expense for $900, and we're going to credit prepaid advertising for $900. How about this one? Salary employees for the month of December totaled $8,000. These are accrued expenses. Whenever there's an accrued expense, we're going to debit the expense and we're going to credit the liability. Here we debit our salaries expense for $8,000, and then we credit salaries payable for $8,000. Guys, do you see it says, but this $8,000 will be paid on January 7th, 2019. What are we going to do then? When we pay the salaries, at that time, we will debit our salaries payable and credit cash. Make sense?
Yeah.
How about this one, guys? On August 31st, Shocker borrows $70,000 from a local bank. A notice signed with principal and 9% interest to be paid on August 31st, 2019. You know, we don't just get money for free, although my husband and I just built a new home this past year, and our interest rate was like 2%. So it almost feels like it's free, but that's not reality. Here, 9% interest. So guys, think about it. When we borrowed the money, we debited cash for $70,000. We credited loan payable or note payable for $70,000. That was in August. But now it's December 31st. So we took out the money August 31st. How many months do we need to accrue for? All of September, all of October, all of November, and all of December. 4 months. How do we figure this out? We take our 70,000 times 9%, which is on an annual basis, is how much? 6,300. Divide that by 12 months to come up with a monthly rate times 4 months. Or we could just take that 6,300 divided by 3 because we're taking a third of the year to show a debit to interest expense of 2,100 and a credit to interest payable. This is an accrued expense. We debit our expense, we credit our liability when we have an accrued expense. Remember cheat sheet, accrued expense. Accrued expenses are recorded when a company has a cost that is used to help produce revenue but hasn't yet paid cash for that cost. The cost is recorded as an expense and the amount owed is recorded as a liability. So we debit the expense account and we credit a liability account. Here's an example. By the end of the year, $300 in salaries have been earned, but employees have not been paid. So what do? We've got to debit the salaries owed as of December 31st of $300 and show salaries payable on this date of $300. Now, it looks as though they had a couple more salaries in January, and then they were paid that $700 on January 4th. But as of the end of December, we need to show the expenses that have incurred that we have not yet paid. A debit to our expense and a credit to our payable. So guys, I'm going to do something real quick. Just hang in there real quick. Pull. Is it not letting me pull question edit? Oh. Oh my gosh, I can't remember my things here. Oh. Oh my goodness. Oh, where are the bicycles? Are they not letting me sign in? Well, never mind. I'm not going to even worry about that. Okay, let's just go back to this. I want you guys to put it in the chat. If a company pays an employee $100 per day for a 5-day work week that runs from Monday to Friday, and December 31st is a Tuesday, what is the amount of the salaries adjustment, assuming that Friday is payday? Is it A, 500, B, 400, C, 300, or D, 200? What they're saying is this is how we accrue expenses. Expenses that have incurred, but we have not yet paid at the end of the period. Put your answer in, A, B, C, or D.
For me, I'll go with D, 200.
D, 200. How many agree it's D? I'd say everyone's agreeing with you. D, 200. Excellent. What's happening here is since the employee worked 2 days, Monday and Tuesday, it will be a salaries expense of 200 and a credit to salaries payable of 200. Great job, guys. What about this? By the end of the year, utility costs of 900 have been incurred, not the word incurrent, but not yet been paid. We paid it the bill on January 6th, but it occurred in December. Therefore, we have to debit our utilities expense and credit our utilities payable. What about this one? At the end of the year, 1 month of interest has been charged for borrowing $10,000 at a 12% interest rate. We need to debit our interest expense of 100 and credit interest payable of 100. When recording the interest payable on borrowed amounts, sometimes students credit the liability associated with the principal amount, like notes payable or mortgage payable. But don't do that. We use a separate account called interest payable to keep track of the balance owed for the principal separate from the balance owed for interest. Guys, try this one. Put this in the chat box. If a company borrowed $20,000 on November 1st at the rate of 6% annually, how much interest expense should be accrued at the year-end date of December 31st, assuming no accrual has yet been made for the year? How many months? The first thing you got to think of is how many months are we accruing for? 2 months. 20,000 times 6% is how much annually? We divide that by 12 times 2, or we multiply it times a 6, however you want to do it. $20,000 times 6% times 2 months out of 12 months. Interest expense 200, interest payable 200. Excellent. Now our last adjusting entry are accrued revenues. When a company provides products or services to customers but hasn't yet received cash, it records the revenue and an asset for the amount expected to be received. So we would debit the asset, probably accounts receivable, and we credit a revenue account like sales revenue. By the end of the year, services of $700 have been provided to customers, but have not yet been billed. We would then show our debit to accounts receivable and our credit to service revenue. Guys, an adjusting entry would be needed for which of the following transactions? A, accrued salaries. B, services provided but unbilled. C, interest accrued on a loan payable. Or D, all of the above. Are you guys saying D?
Yep.
Excellent, guys. Remember, adjusting entries are unnecessary for 2 types of transactions. Transactions that do not involve the recognition of revenues or expenses, we don't need to worry about. Or transactions in which we receive cash at the same time we record revenue or pay cash at the same time we record an expense, we don't need to worry about. So what we're going to do after we're familiar with these adjustments, we're going to then prepare what we call an adjusted trial balance. This adjusted trial balance lists every account balance after updating them for these adjusting journal entries. We prepare this after we create our adjusting journal entries. Because guys, this trial balance is what we'll use to prepare our income statements. Remember, the total debits must equal the total credits. Now, this portion here, the reporting process, we're not going to deal with until next week. There's enough to learn just with these adjusting entries. So unless you guys have any other questions, I'm going to show you the homework. Okay? So the homework for chapter 3, week 1. Now, guys, we did this problem already. For each situation, determine the date for which the company recognizes the revenue under the accrual basis of accounting. You're going to rock that one because we just did it. For each situation, determine the date for which the company recognizes the expense under the accrual basis of accounting. Okay, let's just take number 3. On January 1st, Pizza Hut pays for a 1-year property insurance policy with coverage starting immediately. When will they record this insurance policy?
1 month's worth insurance expenses recorded each month.
Excellent. I can tell you've been working. Next one. This one, guys, read it. Don't forget to read it. Determine the date for which the company recognizes revenues using the cash basis of accounting. Don't confuse that with accrual basis. This is cash basis. Guys, let's take number 1. American Airlines collects cash on June 12th from the sale of a ticket to a customer. The flight occurs on August 16th. Under the cash basis of accounting, when are we going to report that revenue?
June.
June.
Excellent. June 12th. Vincenio,
Yeah.
what we talked about, I adjusted that, okay?
Okay, thank you.
Now, guys, these are expenses, excuse me. For each situation, determine the date for which the company recognizes the expenses using the cash basis of accounting. Guys, under cash basis of accounting, when do we record expenses?
When cash is paid.
Exactly. Under the accrual basis, when do we record expenses?
when the expense is incurred. or purchase
Yes.
goods.
Excellent, guys. Don't get that mixed up, okay? Okay, next. During the course of your examination, okay, we're going to do these together, okay? Because someone said there was a lot of work. There kind of is. Let's do some together, okay, to limit it. During the course of your examination of the financial statements of Trojan Corporation for the year ended December 31st, 2021, you come across several items needing further consideration. Currently, net income is $100,000. Okay? An insurance policy covering 12 months was purchased on October 1st, 2021 for $24,000. The entire amount was debited to prepaid insurance, and no adjusting entry was made for this item in 2021. What do we need to do here? Don't we need to adjust for the rent that was used up?
Yeah. Which would be negative 6,000.
How did you come up with negative 6,000?
Figuring out what the total per month was and how many months was used up.
3 months were used up, 2,000 a month, $6,000. Excellent. Next one, during 2021, the company received a $4,000 cash advance from a customer for services to be performed in 2022. The $4,000 was incorrectly credited to service revenue. Guys, what should have it happened?
Should have been deferred revenue.
It should have been a liability, deferred revenue. So did this overstate our net income
Yes,
by $4,000, correct?
correct.
Okay. Number 3. There were no supplies listed in the balance sheet under assets. However, you discovered, wait a minute, this is a plus. No. It was too
No,
much.
it's a negative.
That's right. Sorry, I had to think out loud. There were, you see, hey, would y'all believe that was a learning experience, or do you think I really screwed up? I really screwed up. There were no supplies listed in the balance sheet under assets. However, you discover that supplies costing $2,750 were on hand at December 31st, 2021. Hey guys, what happened here? They must have debited supplies expense for everything instead of debiting the asset supplies, right?
Yep.
So what do we do? How do we adjust this? Did their screw up increase our net income or decrease our net income?
Increase.
We need to fix it by increasing the net income of $2,750. Correct. Now, number 4. Trojan borrowed $70,000 from a local bank on September 1st. Principal and interest at 9% will be paid August 31st, but no accrual was made for interest in 2021. What are we going to do here? Don't we need to figure out how much interest we need to accrue?
Yes, you need to add 21,000 or 2,100.
2,100 we would subtract, right? because they borrowed from a local bank. Okay,
Correct.
so here, if it was showing 100,000, this lowers it to 90. This increases it to 92,750. So would this be at 90,650?
Yes.
How can we tell? We go and check our work. I'll give you a minute so you can record this. Okay? Got it?
Is there any way we can go over 12? I got stuck on the first one of that.
Yeah, sweetie, your sound is real muffled. Must be like what happens with mine.
It's probably because my computer was on my lap.
Yeah, and maybe that's what happens to me. My computer's on my lap. Okay. Let's go over number 12. Okay. On December 1st, 2021, Wolverine receives $4,000 cash from a company that is renting office space from Wolverine. The payment representing rent for December and January is credited to deferred revenue. Record the necessary adjusting entries at December 31st for Wolverine Company. Okay? So if $4,000 is for 2 months of rent, how much has been used up as of the end of December?
2,000.
Okay, so we are going to debit deferred revenue for 2,000. And aren't we going to credit rent revenue or service revenue? Service revenue for 2,000. Okay. Next, Wolverine purchases a 1-year property insurance policy on July 1st, 2021 for $13,200. The payment is debited to prepaid insurance for the entire amount. Record the adjusting entry for insurance at its year end of December 31st. How many months have been used up as of December 31st?
6.
6 months. So won't we debit rent expense or insurance expense, sorry, for half of 13,200, or is that 6,600? And won't we credit prepaid insurance? $6,600? Make sense?
Yeah.
Next. Employee salaries of $3,000 for the month of December will be paid in early January. Record the adjusting entry for salaries at its year end of December 31st. Debit. Salaries expense. What's our credit?
Salaries payable.
Excellent. 1st, 2021, the company borrows $15,000 from a bank. The loan requires principal and interest at 10% to be paid on October 30th, 2022. Record the adjusting entry for interest at its year end, December 31st. How many months are we accruing for?
2.
2. We will debit interest expense. And remember, guys, do not credit a note payable. You're going to credit interest payable. Okay? How do we figure this out? 15,000.
You do 10% of 15,000 and then divide it by 12 and then times it by 2.
Perfect. Perfect.
Yep.
How much is that?
250.
Office supplies at the beginning of 2021 total $1,000. On August 15th, Wolverine purchases an additional $3,400 of office supplies, debiting the supplies account. By the end of the year, $500 of the supplies remain. Record the adjusting entry for office supplies on December 31st. We'll take what began the year 1,000 plus our 3,400 gives us what?
4,400.
4,400. If 500 is still remaining, how much does that mean we used up?
3,900.
3,900. We debit our expense, we credit our assets, don't we? Does that make sense, guys?
Yes, thank you. I think I just got caught up on the very first one. I put it in
It's
as
okay.
rent.
This is how you learn, though. Check your work. Okay? Do this one. On October 1st, 2021, Hurricane lends $9,000 to another company. So guys, think this through. Hurricane's not borrowing the money, they're lending the money. The other company signs a note indicating principal and 12% interest that will be paid to Hurricane on September 30th of 2022. Record the necessary adjusting entries at December 31st, 2021 for Hurricane Company. How much interest receivable is due Hurricane? How many months worth?
3.
3. $9,000 times 12% would be annualized. To figure out what 3 months is, we divide it by 12 times 3, or we can take a fourth of it, divide that by 4. So what would that be, guys?
270.
$270. Interest receivable. Interest revenue, right? How many agree? Guys, remember, we are not borrowing the money. We are lending the money to someone else. We're getting the interest. On November 1st, 2021, Hurricane pays its landlord $4,500 representing rent for the months of November through January. November, December, January, 3 months worth. Payment is debited to prepaid rent for the entire amount. Record the adjusting entry for rent as of December 31st. How many months have transpired?
2.
2. So we don't have an asset sitting anymore of 4,500 as of December 31st. How much is left?
1,500?
That's it.
1,500? Okay.
So we need to show rent expense of 3,000 got used up. And we need to credit our asset prepaid rent of 3,000. Because then that would show 1,500's left, right? Right?
Yep.
Yeah, that makes sense.
Okay. Next.
Just a general question. When like you're actually doing this in the real world, do you always put the debts first or do you organize it by date?
These journal entries, we always, well, the journal entries are organized by date, okay? When we do a journal entry, we always do our debit first and our credit second. So in the case where it's a debit, whatever the account is, we debit first and then we use the credit second, if that's what you're meaning.
Yeah, that answers it. Thank you.
You bet. On August 1st, 2021, Hurricane collects $13,200 in advance from another company that's renting a portion of Hurricane's factory. The $13,200 represents 1 year's rent, and the entire amount is credited to deferred revenue. Record the adjusting entry on December 31st. So if that is for 1 year's rent, what does that make it per month?
1,100.
1,100. How many months have been used up?
5.
5. So now, shouldn't we show that the liability has reduced because now we've earned the money?
Yeah.
Yeah.
So deferred revenue, 5,500,
Yes.
and we would credit service revenue, 5,500. Now, depreciation on machinery is 5,500 for the year. Record the adjusting entry for depreciation as its year end of December 31st. What do we debit?
Would it be depreciation expense? Or,
Yes.
Oh,
Yes.
okay.
Sorry. And we credit our accumulated depreciation, which is that contra account I was telling you about. Okay. Next, salaries for the year earned by employees but not yet paid to them or recorded are $5,000. Record the adjusting entry. What's our debit? What's our credit?
We debit salary expense.
Correct. And we credit?
Salaries payable.
Excellent. Hurricane begins the year with $1,500 in supplies. During the year, the company purchases $5,500 in supplies and debits that amount to supplies. At year end, supplies costing $3,500 remain on hand. Record the adjusting entry. What do we debit and what do we credit?
Supplies expense and supplies.
Correct. We debit supplies expense and we would credit supplies. Again, you can always check your work. Now, this one is just like what we've done, except you have to pay attention here. This shows the unadjusted trial balance as of December 31st. Then it tells us here's some additional information. The prepaid rent balance is $7,200, which we see is right. Represents payment on October 31st for rent from November 1st to April 30th of 2022. That looks like it's 6 months of rent, right? But how many months have been used up? November and December, 2. So we need to adjust this to show we no longer have 7,200 sitting here because we've used up 2 months of it. Okay? So you'll want to figure out how much this is monthly and then do a debit to your expense and you credit your asset. Number 2, the balance of deferred revenue, 3,000, we see it right here, represents payment in advance from a customer. But by the end of the year, $750 of the services have been provided. Doesn't that mean this isn't all a liability anymore? Doesn't this mean 750 of this has been earned?
Yep.
So when we know it's been earned, what do we debit and what do we credit?
Debit deferred revenue and credit service revenue.
Exactly. So guys, this is going to be just like the other ones we've done. Same thing here, guys. Someone, oh, I'm going to go over this. I do want to say something a minute. This is a hard class. And guys, I wish there was another way to learn it. But the only way I know to learn it is to do problem after problem after problem. Need I gag you? Do you get what I'm saying though? So please know my intent is never to bombard you with homework. I just wish there was another way to learn it. And I have not, as of yet, learned another way to learn this stuff, but to dig and go over it. So if you feel like I'm giving you too much homework, I'm doing it on purpose because it's the only way I know to make it sink in. So I just want you to know my intent is totally to help you guys learn this information. It's not to bombard you with work. It's just, I don't know of another way to learn it. I really don't. And I've been at this. I don't even want to tell you how old I am, but how about this? I've been doing CPA work for 33 years. So you got to figure, I'm getting up there. But I haven't turned 60 just yet. I'm only 59. Okay, next, I'm going to help you with this one because we've got to do a little more work here. They are giving us someone made a comment here, so let me just see what. Are the quiz and homework marked as a 0 for everyone right now? Okay, here's the deal, guys. Jake, I have allowed you, and I need to fix the reviews, but everyone gets 2 drops, 2 review drops, 2 homework drops, 2 quiz drops. What happens is the way the system's set up, you only have 2 recorded anyway, so they both drop. But it will fix itself, so don't worry about that. I promise you it will fix itself. It's just taking your 2 lowest grades, which all you have are 2, and dropping them to 0s. Don't worry.
Oh, so it's calculating all the assignments right now?
Well, even though you've only done 2, it doesn't know anything else but to do that. I was going to go in and take that off so it doesn't keep confusing everybody. Just because, you know how I told you I'm going to drop the 2 lowest? The system automatically sets it up that way. Okay? Make sense? Okay. Here you see an unadjusted trial balance. It says, at the end of the year, the following information is available. The balance of prepaid rent, $7,200, represents payments on October 31st for rent on November 1st to April 30th. What it wants us to do is show the new adjusted trial balance. So these figures, these journal entries came from the previous problem. So what we should be able to do is show that we are adjusting back on this problem here. We debited rent expense and we credited prepaid rent for how much, guys, did we do this for? 7,200 divided by 6 months is
2,400.
2,400. Thank you. So wouldn't our prepaid rent go down 2,400? Make sense? 7,200 minus 2,400 is what? Is our new balance.
Shoot, I don't know if that was actually right. I was still on 14.
Okay, let me, 1 second. 7,200 divided by 6 months is 1,200. So 2,400, okay? So if we've got 7,200 minus 2,400, we should have a new balance sitting there of 4,800 in prepaid rent. And our rent expense should now be 2,400, right? Got it? The balance of deferred revenue, 3,000, represents payments in advance from a customer, but by the end of the year, 750 of the service had been provided. Remember, we debited our deferred revenue and we credited service revenue of 750. So our new deferred revenue balance should be what?
$2,250.
Okay. And our service revenue should be 750 more than this. 51,950. Make sense?
Yes.
An additional $700 in salaries is owed to employees at the end of the year, but will not be paid until January 4th. So our salaries payable is going to be 700. And our salaries expense is going to be 35,000 plus 700. Right? The balance of supplies, 4,000, represents the amount of office supplies on hand at the beginning of the year, plus 1,700, beginning of the year of 1,700 plus an additional 2,300 purchased throughout the year. But at the end of July 2000, or at the end of December 2021, only 800 of supplies remain. So our supplies here should only be 800, correct? Because 3,200 were used up, right? So our cash is at 10. Our accounts receivable is at 15. Our common stock is at 11. Retained earnings is at 6. See how that works, guys? They're wanting you to take the information from the previous exercise and adjust these accounts to come up then with a new adjusted trial balance. Next. Below are the restated amounts of net income and retained earnings for Volunteers Inc. and Raiders Inc. for the period 2012 through 21. Calculate the balance of retained earnings each year for the company, each company. Neither company paid dividends during any time of the year. So basically what they want you to do is each company started the year in 2013. So if in 2013 their income was 30, you add 30 million. In this one, if it was a -7, wouldn't the new figure be 23 million? If they added 41, the retained earnings would be 23 plus 41 or 64. If we added 135 to 64, it would be 199. If we added 30, it would be 229. What happens when you, it's a loss of 131,000? The 229 minus 131 is what?
98.
98 plus 577 gives me
675.
675 plus 359 is what? 1,000,000.
1034.
And then the 1,034 plus 360 is 1,000.
394.
Right, you see, you're gonna do the same thing here. The 11 minus the 43 gives us minus, is it 32?
Yes.
Minus 32 plus 63 gives us
31.
31. 31 plus 63 gives us 94. And on and on and on. What they're wanting you to do is understand that retained earnings is an accumulative effect of all the years combined. Now, it told us it did not pay out dividends, so that's why we didn't have to take anything into account. Make sense?
Yes.
How is everyone doing?